Great. So welcome you all once again to the second section of the investment appraisal. Today we are going to look for the other techniques. That is the discounted cash flow techniques. That is today's agenda. So at the end of the day, you should be able to know how to appraise investment using the discounted cash flow techniques. Discounted cash flow techniques. Good. That's today's section. Good. Good. So discounted cash flow techniques. Here we are going to look out for 3 items, and that is the return. For the discounted cash flow techniques, we are going to consider the time value of money. That's the central focus. We consider what? Time value of money. So time value of what? Money. That is a popular quote. 1 Ghana cedi today is not the same as 1 Ghana cedi tomorrow. Or what you can use 1 cedi to purchase today. Tomorrow you cannot use 1 cedi to buy. You have to spend more. The first 2 approaches that we have to look out for, they do not consider the time value of money. So it serves as a disadvantage for the first 2 methods. What are they? The accounting rate of return and the normal payback period. The payback. These 2, their major challenge is that they don't take into consideration the time value of what? Money. But the discounted cash flow techniques, they take into consideration the time value of what? Money. Good. So basically, that is the difference. So the issue with the time value of money is being solved by what? Discounting the cash flow. So over there, the first technique that we are going to look out for, the second part of the payback. So we have what we call, remember that this one was on number 3 in the notes. Number 3. And then we will look out for first, adjusted or discounted payback. Discounted payback period. So payback period. Good. That is the approach. The second approach I'm going to look out for is almighty net present value, NPV. Then finally, we look for internal rate of return. Then we are done. That's the end of the game. So today, we will look out for page 2. Then we will see. So now let's start with the adjusted or discounted payback period. So it means that there are 2 types of payback. We have the normal payback without any discounting. Then we have what? Discounted payback period. The normal payback period, we don't discount the cash flows. So here we have to now factor into consideration the fact that if I have 1,000 Ghana cedis today, exactly 1 year later, it no longer be 1,000 cedis. The value will drop. Maybe it can be 900 Ghana cedis cost. So that's what we are going to take into consideration. Okay. So let's reproduce our usual example, the one that we did in the previous studies. Good. So discounted payback period. Discounted payback period. Over here, we are going to discount all the cash flows. And then the normal payback treatment or normal payback calculation continues. That is it. So let's pick question. If you don't have it there, don't worry. Let's go to the handout. We can get 9 questions in there so that we can move faster. So you can try these ones for me. Good. So it says that using the data in example 2 above with a cost of capital for 10%. Okay. Using what? The data above in example 2. So let's go to example 2. Example 2, where are you? Example 2, where are you? So example 2. If you can reproduce last example for me, I'll be very grateful so that I can use that one. Okay, I have example 2 here, payback. So it will target publications considering a new project requiring a capital outlay of 140,000 on equipment and an investment of 20,000 working capital. The project will have 4-year life with an estimated residual value of 5,000. The project is expected to earn the following net cash receipts. You know, there's a cash receipt, right? Net cash receipt. You know, that payback, we need what? We need cash flow, not profit. So take notes. So that is it. So they are here 90, 48, 90, 25. Should the investment be undertaken? So good. Okay. So now the cost of capital is 10%. Let's calculate the payback period. So first, let's set the table. So the payback, adjusted payback period, all what you have to do is this. We will have year. So I write a year. And then we will have the cash flows. So cash flows. Then I'll have discount factor. Yes, discount factor. That's the changes in the monetary value. Good. Then you have the present value of cash flow. So PV of what? Cash flow. Then finally, the balance. Then we are done. So now let's see. Good. So if I don't use the example that we solved last meeting, then that means that one will be your own. Good. So how many years? With the payback, we normally start from where? Year 0. So take note. We start from year 0. So if we go to the question, year 1 up to 4. So I'll start from year 0. Year 0 is when you invested the funds. Now, year 0 in investment appraisal means now, today, when you are making the estimates. So I'll start from year 0. I'll go to year 1, 2, 3, 4. Then you are done. Great. So the year zero. In fact, year zero, what goes there? Let's explain year zero. Assuming that you want to enter into a project. So now you are making estimates to know whether this project will yield good. So year zero becomes now today. So today, what are you going to do? I have to make the investment today and wait exactly 1 year later, what will be the yield? Exactly 2 years later, what will be the yield in that order? So year zero refers to now, and usually year zero only two items, whatever you invested and probably the initial working capital. So for year zero, you are looking for the investment and the initial working capital. That's for year zero. Go. So let's go to the question and pick the initial working capital and the cost of investment. So a new project requiring a capital outlay of what? 140,000 on equipment and an initial investment of 20,000 in working capital. So therefore, the value of the total capital will be 160,000 at the initial date. So that would be 160,000. Agreed. So you need 140,000. And now you have to also make 20,000 available. Now I'll explain working capital in detail when we start the investment appraisal. Good. So here you got 160,000 Ghana cedis. Agreed. Let's go to year one cash flow. So year one, the cash flow is 90,000. Year one, 90,000. Year two is 48,000. Year three is what? 90,000. Then year four is 25,000. Now year four, we have to add if there's a scrap value in the question. Yes. Estimated residual value of what? 5,000. So we are assuming that at the end of the project life, you are going to sell the machinery or the plant involved. So if you sell that plant or the equipment, you get 5,000. You have to add it to the cash flow to form part of the cash flows. So it will be 5,000 plus the 25, right? So the final year, it will be the 5,000 plus what? 25 in the final year. So the final year will be 30,000. So that will be 30,000 Ghana cedis. Great. So take notes. Good. Now we are done with the cash flows. Let's go to the discount factor. The examiner said that we should use discount factor for 10%. Good. So with 10%, how do you calculate the discount factor? Please. We use several approach. If the discount table is there, the annuity table or the discount factor table, all of them are there. You can read from there. But let's assume that they will not give it to you. So let us calculate our own discount factor. The rate is 10%. So that means every year, the value of a CD must reduce by what? 10%. That's the meaning. So if I have to receive 90,000 cedis at the end of year one, I have to reduce it by 10%. That's all. If I want to receive 48 in year two, you have to reduce it. Reduce it 1, 2 in that order. So to get the discount factors, just pick one like this plus the R, that's the rate, all to the power n. We are done. So if you are in year one, put year one here. If you're in year two, put 2 there. If you're in year 4, put 4 there. That is how we arrive at the discount factors. If you're in year 0, put 0 there. Just that always year 0 is equal to 1. Or the discount factor for year 0. Why? Because 1 Ghana cedi today, we say year zero means today. So that means 1 Ghana cedi today is the same as what 1 Ghana cedi. Unless what time change, time value, unless time change. When there's a change in time, then the value too will change. But if the time is the same, the value too will be the same. Or you can also do it this way. Or alternative, 1 plus r to the power minus n. So if I'm year 1, you put 1 there in that order. So let's start for year 1. 10% would be 1 out of 1 plus 0.1 all to the power 1. So what will be the answer? Please run your answer to 3 decimal places. Run it to 3 decimal places. Or if you want to use the other approach, it will be 1 plus 0.1 all to the power minus 1. It's going to give us the same answer. So what do you get? The one that you are done with it, you can share it with me so that I can record it on the board. So therefore, here 0 is always 1. If you put 0 here, any number raised to the power 0 is what? Is 1, right? Okay, so it's 1 over 1. 1 divided by 1 is what? Is 1. So the final answer is what? 1. Everything 1. We are done. Okay, so year 1, what do you get? Year 1. Okay. Let me fill in blanks. 0.909. Agreed. I try that you get the same discount factor. So year 2 being 0.826, 0.751, and 0.683. Good. Yeah, then that's the discount factors. Then you find how do you get a present value? Now, each cedi, the value in a year's time will be what is 1 Ghana cedi. If I want to receive it in a year's time, the value today is 90 pesos, around 91 pesos. So if I have 90,000 Ghana cedis, how many cedis will I receive? If the value by then, the value be what? 90 pesos. So you multiply, right? So let's do it again. So to get a present value, the discount factor times the cash flow. It will be what? 160,000. Don't forget the first year, put it in bracket. Let's put it onto in bracket. So this by this, what will be the answer? This by this. Great. Give me 81,810. So 81,810. Then here will be 39,648. 39,648. Then 67,590. Good. So 67,590. And finally, we have 20,490. 20,490. Now let's find the balance. Let's be calculating the balance. Let's see. So let's come here. At the start of the project life, we have invested 160,000. So we have 160,000 to be recovered from the project. So 160,000. So put it in bracket. At the end of year 1, it will give us 90,000, but the present value was 81. So let's offset it from whatever we invested to see the amount left. So that is what will be the balance left. So the balance left will be 160,000 Balance 160,000 less 81,810. That'll give us 78,190. So 78,190. Then we go to the second year. The second year too, we had 39,648. At least it will offset the difference. So let's put this one in the bracket so that we still have 78,000 more to clear. So therefore, we take it off from the amount given us. So it will be the 78,190 less what? Less the 39,648. So that will give us 38,542 agreed. So that will give us 38,542. So 542. So that is what left for us to recoup. Now, when we go to year 4, sorry, the third year, that's year 3, we do have 67,590. But we need only 38. So that means here, when we reach there, just put it out there. That means, so check. If what we have is more than this, then that means we will get some fraction. Yes. Because the 38, this year we had more than 38. So we cannot say that the payback period is what? Year 3. No, that's not in year 3. 2 years and a fraction of year 3. For the whole of year 3, we produce 67. We pick only 38. So let's take the fraction of 38 out of the 67 that we picked. So that is it. So the payback period will be, we work it out in 3 forms. Any of them be correct. So first, maybe I want all of them in years. If I want all of them in years, then the payback period will be calculated as follows. So the payback will be as follows. If you want it in years, payback will be, so I'll take, it will be 2 full year plus, yeah, I pick only 38,542 out of 67,590. So this answer will be what? Will be the in years. That's the payback period in years. So this one will give us, so that is 3842 divided by 67590. That'll give us 57. So it will be 2.57. 2.57 years. Good. So this is in years. This is in years. What if you want some years and months? So second approach, years and months, it will be 2 full years plus, now 38,542 all divided by 67,590 times what? 12. So some in years, some in months. Good. So just multiply the fraction here by 12. So this one by 12 months. That will be 6.8. So you can make it 7 months. So it will be 2 years and what? 7 months. That's the payback period. 2 years and 7 months. We are done. 2 years and 7 months. Okay, now I want some in years, and then in days. So kindly do that convention for me. Good. Now let's see. So if you want it in days, just end this section, make it 365. So it will give us 2 full years and 208 days. Good. Received. Good. So that is it. So that is the end of the adjusted payback period. So if I do one, you do one to one mapping. Good. That's the end of adjusted payback period. So let's try if you can back the second illustration. And then I'll pick, but we have to look out for a situation where the cash flows are constant. So I'll work one now where the cash flows are what? Constant. Good. Where the cash flows are constant. Okay. So basically, meanwhile, if we solve this without the discounting, it's 2 years and what? 9 months. But if you discount it, it will be 2 years and what? If you discount it, it should take longer period. Discount should take longer period. I think change the cash flows. There has been amendment. This cash flows 40, 50, 90, 30. Okay, good. But there has been changes in the cash flows, which is not reflected in the question. Thank God. Now let's see. So this one is a trial still pending. Let me still go to. Okay, so still. So now the example 3, I'm adding this to it. The example 3. So with example 3, still adding this to it. Good. Okay, great. Now with the payback period and then the adjusted payback period, all of them have the same decision rule. So the decision rule for payback is still the same for that of what? Account the adjusted payback period. Sorry. With payback, you accept the project that can pay back. That's the decision rule. Once that project can pay back, you accept it. Assuming that here, for the figure is around 300. So it was not up to, yes, still negative. Finance was still negative. It means that this project, the cash flows cannot pay back the capital investment. So that one, do not accept project like that. Now, all the decision rule we have for single investment, we have for what? Multi-investment. With a single investment over here, accept the project that would what? That can pay back. But if they are multi-investment, maybe 2 or more projects, for that one, you accept the project that what? With the highest or with the shortest payback period. Because you don't want your funds to go and lock up somewhere. So you accept project that can pay back what within the shortest possible time. So in short, accept the project that would what shorter payback period. So that's the decision rule. Good. Now you should also know the decision rule for that of what accounting rate of return. Decision rule for accounting rate of return. Good. Then you are done. Great. Now let's look at the NPV Almighty. But before that, let's analyze the advantages and then some few challenge of the discounted cash flow techniques. Now, some few advantages of the discounted cash flow techniques. Now, the discounted cash flow techniques are very good. They are a bit offer a better view and a valid conclusion than the previous one. So the advantage of the discounted cash flow techniques. Advantage number one, I'll give you only three. All these, all the all the discounted cash flow techniques, all of them will have these three advantages. Straightforward. So advantage number one, it considers the time value of money. That means it takes into consideration risks. So it considers the time value of money. So consider time value of money. That's a very good news. Unlike the accounting rate of return and payback, no way these two people they don't consider. Don't forget that there are two types of payback. We have the normal payback, that one no discounting. Then we have discounted payback or adjusted payback. What we just look at it right now. Then good news number two, it uses cash flow but not accounting profit. So therefore, changes in accounting policy might not affect the decision. So it uses what? Cash flow. So we use cash flow but not profit. We use cash flow but not profit. Why is it a good news? It's a good news because you can manipulate the profit, you can manipulate cash. That's all. You can manipulate your profits, but cash is very difficult. Cash is very difficult. Cash is very difficult. Cash is very difficult. Good. Then the third one, we can talk about the risks and then uncertainties. It's also consider risks and then uncertainties. The discounted cash flow techniques. That's the risks associated with the cash flows. The risks associated with the cash flows are all considered. Risks associated with the cash flows are considered. So basically, risks risks are considered. So risks. Good. So these are the three important or three good news about the discounted cash flow technique. Good. So now let's look at this question before we do the NPV. The same handout, getting to the latter page, getting to latter page, getting to latter page. think that I opened a wrong file. Yes, I opened a wrong file. I have updated this. So it's supposed to be 36 pages, not 35. So let me open the updated version. Now let's use this one. This is a current. So this one is good. Let's go to the last page. Last page. Good. The question is here. So this is ICA November 2019. It's called External Company Limited. Good. So this will be your trial. I just want to explain few stuff here and just move on. I want to explain few stuff here, then move on. Okay, the disadvantage for the discounted cash flow techniques. Disadvantage for payback period. You want the disadvantage? I think we did that one yesterday. The disadvantage of payback period. We did that. We said that it does not take into consideration the cash flows after the payback. I also said that. Okay, you are talking about the discounted payback period. Okay, the discounted payback period. Now, all the disadvantage that we look at under the payback, they are true, except for one. Let me go to the board. Let's go to the board. You know, the normal payback period have a particular sickness, has a particular disease, the normal payback period. So there's a savior. The savior is the adjusted payback period or the discounted payback period. So the sickness or the disease was it failed to consider the time value of money. Time or value of money. That's the major sickness of the normal payback. And then the adjusted payback period came to solve that sickness. So it has been healed over here. All the other sickness, they remain the same. All the other disadvantage. So all the disadvantage that we learned under the payback period, they are also the same for adjusted payback, except for time value of money. If you mention it here, it's off. So the other ones such as what? Other ones such as it failed to take into consideration the cash flows after the payback period. Like the one that we saw, the year 4 cash flow wasn't considered at all. Good. So that is that. Great. So I hope it's okay. Again, it can also lead to a wrong choice because you are looking for what? The project that will pay back what? Short possible time. So it may end up, you may reject project, the most profitable project. Let's assume that the most profitable project will pay back in the late or will take longer time to pay back. You reject it and go in for the project that will pay back at a short possible time. Meanwhile, it is not what profitable. That is the disadvantages of what the payback period. Now let's go to our question here. Let's go and just see to the question that we are solving. This is November 2019. So here let's go straight to the requirement. Select the appropriate plans on the basis of payback period. So this is the homework number 2. So example 3 is still pending. I'm adding this. Now you realize that in this question, the cash flows will be constant. I think I will come and then solve it again after the MPV. But check this and you'll be fine. Explain two advantages of discounted cash flow method of investment appraisal. Two, just two, and then you are done. So I think you can do justice to it. So let me add this requirement to it, then you are done. Now let's go to investment appraiser. You're welcome. Investment appraiser, NPV. Fact is the popular one among the methods. Net present value. Net worth present. Net of today's value, present today. So net present value, popularly known as NPV, net present value. Now, net means we are subtracting something from something. So net means all benefits, so all inflows, cash inflows, less all outflows, we are done. So all benefits that the project will generate, put it one side. These are benefits. The benefits or receipts or your revenue, less what the sacrifice that you have to. So putting it together, that's what I mean by net. So net means if you want to enter into any business, put all the benefits one side, then relax, come back again, put all the sacrifices, all the investment, the amount that you have to spend on it, in fact, putting your time, factor everything into consideration. Then what do? You take it off, you get the net. So the net. Now let's go to the present value. So that means after you get the net, find its present value. So in short, then I can do that. I can find the present value of what? Of the inflow less what? The PV of outflow. So that's the formula. So it's equal to PV of what? Inflows, cash inflows. PV of PV of cash inflows minus PV of what? Cash outflows. So PV of cash outflows. So basically, that is it. That is the NPV, net present value. It is the popular one, and we will explain why it's the most preferred method. MPV is the most preferred method. So that is it. We will explain why MPV is what? The most preferred method. That's the net present value. All benefits one side, all costs, all running, operating costs or sacrifices one side. Just that find their present value. Because 1 cedi today is only the same as 1 cedi tomorrow. So you have to take the discount into consideration. And that's all. Just that we have a nice format for it. So I'm going to look for the format. Now these inflows, what are the examples of inflows? Inflows, cash inflow, any receipt. So the inflows can be what? One, can be sales revenue. Sales revenue. So examples of the inflow: one, sales revenue. 2, it can also be what? Benefit. Benefit. 3, it can also be cost savings. Cost what? Savings. If you buy this equipment to save you for paying certain costs, so like heating cost will be saved. Heating cost will be saved, or cooling cost will be saved. So you have to go and buy certain machines so that you save certain costs. Then that cost that you save is the benefit. So find the present value of the cost that you saved, then less all your sacrifices. 4, it can also be what? Receipts or fees or subscription. Annual subscription. Yes, the one that you are paying to the institute. Yes. So if I'm considering forming an association where every year or every month they will pay dues or fees or subscription, it will be my what? Inflows for that project. So these are the examples of inflows for the project. Now, for the purpose of your examination, sales revenue is considered to be the most one. That does not mean that if you go and see benefits, you tell the examiner that you won't solve it. No. Good. So that is it. We are done. Now, what about the outflows? Outflows to 1, your variable cost, your running cost. So 1, running cost, all the running costs, operational costs, operating expenses, the cost that you incur specifically. Good. So that is it. Now let's look at the format for investment appraisal. Good. The format for investment appraisal. Format for investment appraisal. A gentle reminder, example 3. We are doing 3 items and the example 3, a gentle reminder. We are calculating payback, adjusted payback, and accounting rate of return. If by then we are done with MPV, oh yeah, I'll add MPV to it, making what 4. If the time we finish with account rate of return, oh yeah, I'll add account rate of return. If you're able to do this, then you should be fine. These are the methods. Okay. Yes. So now your work is this. Okay, that's fine. The 3. Now the format will be like this. But it's not a format. How do you prepare your profit and loss statement? The same way, just that here we have a way of presenting it. That's all. It's not too wide from a normal profit and loss preparation. So first we call it NPV layout. So NPV layout. NPV layout. MPV layout. Good. Now this must be part and part of you. This format. Kindly join me when we are designing the format together. You may need it. You may need it too. Okay, so let's draft it together. Kindly be with me. Okay, good. All my team are in position. So what you do is this: you start with your year. Now, today, year 0. And then you go to year 1. In fact, the format is long. Okay, I think I'll speed it. You go to year 2. Up to the last year, so that's year end. Maybe year 5, year 6, year 7, year 4. That is it. Then you start your sales revenue, or you start with the inflows, your sales revenue, or your receipt fees. So I've mentioned all the items that will form part of what the inflows. So any of them, you see one of them in the question, either receipt, benefit, cost saving, fees, subscription. If I want to set up a tuition class for next academic year and I want to calculate the MPV out of it, I'm not going to sell anything to the students. I will only take what fees. So tuition fee become what the inflow. So I have to bring it. How we get it? Good. I think there's a question on that. So your sales revenue, so much, so much, so much. You are done. Then you go to the cost. This shouldn't be a big deal for management accounting students. Why? Because you've done the marginal costing, you've done absorption costing, so calculation of cost and profit statements. Okay, basically, it's the variable cost. You know your variable cost, right? So the variable cost, year 0 will be dash. Nothing goes to year 0. So let me, dash. So variable cost. Variable cost to year 0 dash. Put it in brackets. And you know the composition of variable cost, right? Direct material, labor, and what? Yes, direct ones. When you subtract, what do you get? You get contribution. In fact, you can boycott this. It's not compulsory to do that. Contribution dash. Then you get this. I hope you get it. Now let me pause here for you to ask me a question because the format is very long. Good. Very long. Now, from contribution, then you write this one is very important. Use red pen to write it if you do have some there. Incremental fixed cost. Incremental or fixed cost, not just fixed cost, but it must be what? Incremental. The incremental fixed cost, so much less, so much, so much. Incremental fixed cost. Incremental or fixed cost. Do you add or you subtract? You have to subtract. Then when you take your incremental fixed cost from this, you get what? Your profit. Cash profit or cash profit. But you've not done anything, no. This is marginal costing. Marginal costing. That's the profit statement. Marginal costing. Good. So it should be okay with this. So the profit will be here, so much, so much, so much. Year 0, it will be that. Everything. For year 0 will get its item very soon. Once you have your profits, if there's tax in your question, tax. Maybe they pay tax at 20%. Tax, they'll ask for 2 items for tax. Tax. Tax it will be in 2 ways. So normally, if the company pay tax in the same year as and when profit arise, we pay tax on it. So that one, the tax must be in the same year. Good. Now let's assume that the tax will be 25%. We calculate 25% on this figure. If we pay the same year, put it there, put it in brackets. So that's the tax. You find it on this thing. But make sure that it is what positive, because we don't pay tax on loss. We pay tax on income. Good. So like that. Now, in some situation, we will inform you that, but that's a real case. Year one tax will be paid in year two. That means tax is being paid 1 year in arrears. Tax is being paid 1 year in what? In arrears. So that means the year one tax will be paid in when? Year two. Year two will be paid in when? Year three. And year three, year four. And then year four, year five. So it means that for that one, in that situation, you need an extra year. That year, you need extra year or extra column for the year. So because of the tax, I'll go by one. If the last year is year three, here must be year four because of the tax. So year one tax, I'll do the calculation on this figure. Assuming that year is 100. I'll calculate the 100, but 25% on 100, I'll put it here. Here will be dashed. Why? Because the tax must be paid here. So I'll put in brackets in that order. So in short, if the tax is being paid 1 year in arrears, then year one tax will be paid when? Year two. So here will be dashed. Come and put it here. Come and put it here. And then this tax, this year's tax will be paid when? The following year. Good. So because of the tax, that's why we are bringing another year there. That is the tax section. I hope you get that. Very good. Very good. Extremely good. Now, let's see. So I'm done with the tax section. Then you go to tax save on capital allowance. You know, depreciation has not been included so far. So tax save on capital allowance. Tax save on capital allowance. So tax saved on capital allowance. Good. So tax saved on capital allowance. That's the next section. Please, it's not compulsory for the examiner to give you everything in one question. No, not at all. It's not compulsory for the examiner to do that. So maybe few of them, combination. But it's your duty to learn everything, because you don't know which one you're going to assemble and give it to you. So tax saved, I'll do the calculation later. These ones, I cannot use this to explain. So the format. Let's record it there. We look at them one after the other. Tax saved on capital allowance. You know, the tax man will not allow you to charge your depreciation when you're going to pay tax. No. Instead of that, they have their own depreciation. I call it taxman's depreciation. But the technical term is called capital allowance. So it's the same as the tax authority calculating depreciation. But they will call it what? Capital allowance. They will not call it what? Depreciation. That's all. Then, right, we are going to the crucial sections. Then you go to disposal. Assuming that this project, at the end of the year, the machinery or the plant that you are buying, or the motor vehicle that you are buying, you can sell it. So to have a disposal value or scrap value. Bring it, we call it disposal value. But it must be a net of tax. That one, put it in the year that they're going to dispose it. If they don't tell you anything, put it at the last year. So dash, 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 and then last year. That's put it exactly when they are going to what? Dispose of the plant or the machinery. If they don't tell you anything but the scrap value in the question, put at the end of the asset life. But sometimes we can inform you that the machinery will be disposed of a year after the life of the machine. So 1 year after. So now don't go and place it here. Create another year. So the next year, so we put it here. Good. That's the next year. Agreed. So 1 year after the useful life of the asset, or a year after. So take note. These are the terms that we. Then item number 2 that I'll talk about is working capital. Working capital. That one will come to year 0. Put it in brackets. I will explain. So for now, it might seem like a format, but I will explain that. The last year is positive. Good. Working capital. Now let me throw the come a bit down to capture everything fast. Good. Now let's see. Then you go to cost of investment or capital outlay. Cost of investment or capital outlay. Cost of what? Investment. That one also be in year 0. Like what you are investing, the capital sum, the initial capital. If they don't tell us anything, we have to assume that it will be invested in when? Year 0. That's now. But you can't tell me that you want to run a taxi business and you start the taxi. You know, you're not going to rent the taxi, but you buy the taxi 2 years after you start the business. No, to not work like that. You have to buy the taxi upfront, or buy the vehicle, or go and rent the vehicle. Whatever means, get the vehicle first before you start the operation. Good. So it will be here. Then we are done. So when you are done like this, and learn all of them, total them, and then you sum them up. This is what we mean by net cash flow. So sum them up like this. Then I'll continue. In fact, supposed to continue again, but good. So you call it net cash flow. Net what? Cash flow. So it's some from where? The last total here. So all these, they are total so much. All these, they are total so much. From here, they are total so much. So much. Definitely this one will be negative because negative, negative, it will be negative. Then what do? Then the discount factor continue. So kindly get it for me. In fact, we are done with the formats of the MPV. Now I'll take my time and explain each and every item for their rules. The one that I put as story there, in fact, they have a specific rule. The remaining ones have a general rule. So I'll go through the general rule with you. Then these ones, we go through them specifically But they have a specific rule that need to be applied, and that's all. Relax, and you'll be fine. Now I want to continue, but I'll continue from the format. So I'll use the format to continue. I've drafted it here too. So let's go to the NPV. I think I drafted it here too. So I'll use the format to continue. Good. So now, right from the net cash flow, after adding everything here, right from the net cash flow, the next is the discount factor. Is the discount or factor. The next is the discount factor. Good. Is the discount factor. Great. Now the discount factor, as usual, you find the present value of the cash flows. So then you get the present value. So discount factors, I think we've looked at it under the adjusted cash flow, adjusted payback period. So that is it. Now the present value, after multiplying the discount factor by the net cash flow, you get the present value, and that is it. So now I'll take my time to go through each of the items one after the other. Now, if you add all the present value together, that is the MPV. So the MPV is start from negative here, plus all these ones, then you are done. So this one is note 4, note 4 and note 5. So all of them, they are notes to it. That you'll be fine. Now let's go to the main issue. All of them have their own notes. So tax, for this one, making 3. But for the tax, I've informed it, I've mentioned it. Then that's all. So from here, discount factor continues, and then the present value in that order, but the space is not enough. So from here, discount factor, I think, let me do it this way. Can I dash the whole thing? Yes. But in the format that I show on the screen, and not underline them nicely. So let's assume that this is your net cash flow, network cash flow. I'm just assuming that this was your net cash flow. Then you continue the game. I tell the examiner that discount was factor, maybe 10%. You find a discount factor, you record them here, and you multiply. You align it. The net cash flow times the discount factor, give what we call the present value of what? Cash flow. The net cash flow times the discount factor will give you what? The PV of cash flow. So that will be double underline it. We are done. So finally, this is the outflow. The outflow. Have you seen the PV of what? Outflow. So present value of outflow. Then all these will be what? The inflows. So all these are what? The inflow. The PV of what? Inflows. Then you will okay, we will depreciation. Now, depreciation should not be part of NPV, but we have a cell for if you want to calculate for the tax save on capital allowance, depreciation is non-cash item. You look at all those stuff. Look, you look at them. So when I reach there, I'll pick the question again to explain. Great.
PV of outflow is equal
So the MPV is equal to
all benefits.
all cash inflow. These are the cash inflows. 1, 2, 3 here going. This is a cash outflow. So therefore the MPV will be, I'll sum all this one up and subtract this one from it. Or this minus minus. Whatever the answer is, I'll put it down as the MPV. The net cash flow. Then you are done. Good. So that is it. That is great. Now let's look at the main issues. So the items that need further explanation, let's look at them. Now let's continue the game. We have specific items that you have to include. So they are the one that we are going to count for. First, I've talked about the tax. So let me talk about the general issue. Then I'll look at the specific ones we are done. So that is. Now let the camera go up more. Coming in. Now, not every cost, not every item that you can include in MPV. Not at all. So the items are called cash flow. So not every cash flow that you're going to include it in your MPV calculation. Not at all. We will not agree. So definitely some of the cash flow will be added. If you go to financial accounting, they will tell you that components of cost, right? Cost of inventory. Here too, we have the component of inventory, component of MPV. We call it relevant cash flow. Relevant or cash flow. Relevant cash flow. Good. Relevant cash flow. So that means some of the cash flows are relevant. Some of them are what? Irrelevant. So the items that you have to record in MPV, they must be what? Relevant. Or the items that must form part of the cash flows, or only relevant cash flows must be recorded. So how do you determine that this item is relevant and must be included? It's very important. Other than that, you may end up adding all the cash flow that are not what needed or interested. So take note. Good. So the criteria for the inclusion of cash flows, there are three. Before you record anything in the MPV, make sure that they pass these three tests. First item, the cash flow must be in future. Must be in what? Future. So the first item on the list, the cash flow must be in future. So the cash flow must be in future terms. So, well, the future, let me make it capital because it's the future. So that means if you are considering investing in any project, consider the cash flow that you are likely to, or they are likely to occur in a future date, not the cash flow that you have thought arrived or has already occurred. So now you are considering buying a car for your business or a new business. Now the issue is this: you have to take into consideration the cash flows that you incur when you buy the car, not the cash flow that you've already incurred them. No, not at all. So the cash flows must be in future. So only future cash flow must be included. So if there's any cash flow that you have if there's any cash flow that you've already incurred, it should not be part of it. So that's past and sunk costs are irrelevant. So on that note, past and sunk costs are irrelevant. Past and sunk costs are irrelevant. Past and sunk costs are irrelevant. So here, past and sunk costs must be ignored. So past and sunk costs must be ignored. Past and sunk costs must be ignored. So these two costs must be ignored. Why? This is in the past, it's not in future. Past cost which has already been incurred, and then the sunk cost, that is in category. They are the costs that has been incurred, and no future decision can change that. Cost incurred, and nothing can change that, like committed cost. Good. So that is the first criteria. Now here, example of past cost or sunk cost is what you mean by feasibility studies or research cost. Feasibility or studies. You are considering buying a car, so you call an engineer, and then you come and then ask you some few questions, or the engineer advise you that if you're going to buy a car, buy this type of car. Don't buy this type of car. This type of car is no good. They are not strong. In fact, this type of car will take all your money away. So obviously, in this type of projects, go in here, don't go there. Now, when the person tells you that don't invest into that project, the person is working, so you definitely charge you money, and that money is called research and feasibility studies. Whether you undertake the project or not, the person will take the money. You have to pay that person, or you incur that cost. So that cost is a past cost. So it must not be recorded. It must not be in the Mpv. Must not be recorded in in the books of the Mpv layout. So in short, feasibility studies or research cost should not be included here. Do not include it. Why? Because it does not qualify. Feasibility, you've already incurred feasibility studies. Good. So that is it. Now, criteria number two, or condition number two, it must be cash flow. Wow. The item must be what? Cash flow. It must be a cash flow. Cash flow. It must be involve movement of money, that you are paying money or you are receiving money. If there's nothing like that, word dodge or ignore. So before you can record anything in the MPV, it must be of cash flow. So all the non-cash items must be ignored. So here, all non-cash items must be ignored. Non-cash items. Examples of non-cash items: almighty, depreciation must be ignored in MPV. So the cost must exclude depreciation. All the operating costs, it must exclude what? Depreciation. Why? Because it's what? Non-cash. Non-cash. Provisions, bad debts, all of these are non-cash. Must be ignored. So definitely, examiner one day will include it and inform you. What do? Take it off. Good. Now, each criteria, we have specific items that must be ignored. So in exams, all what you have to do is this. You have to mix it. We give you, let's say, 4 inclusion, 3 exclusion from each of the category. Now let's go to the last one, then we are done. The last one, very important. The last one is very important. The cash flow must be what? Incremental. I like that term. It must be incremental. It must be incremental. So 3 terms. It must be in future, must be cash flow, and must be what? Incremental or incidental. Now let's explain the incremental. Good. Let's explain the incremental. Now with the incremental, here we are saying that include only cash flows of the project directly coming from the project, directly associated with the project. Cash flows that if the projects are not there, they're not going to incur that cash flow. So include cash flows that are directly. So without the project, that cash flow will not exist. That's the cash flow that we are looking for. It is incremental. It moves with the project. When the project moves, that cash flow also moves. So that is the incremental cash flow. Good. Here, it means that general fixed costs must be ignored. So each and every section, what must be ignored must be stated clearly. General fixed costs must be what? Ignored. It means that general fixed costs must be ignored. General fixed costs must be what? Ignored. General fixed costs must be ignored. The only fixed cost that you have to include is the incremental fixed cost. Here we don't allocate overheads. It must be directly. So general fixed cost must be ignored, and then apportions overhead must also be what? Ignored. Here we don't apportion overheads here. No. Either it is direct allocation, direct. If it is apportioned, no, it must not be apportioned. So that is it. Now that's the incremental. Now let me also sound this. Do not include the company's details in that project. So the company's operating cost has been included in the project operating cost. No, take it off. We want revenue coming from the project alone. Operating costs coming from where? The project alone. So they can get the net return coming from where? The project. If you want to calculate the net return for the company, go and take the company's records and calculate that one alone. Here we are what? Appraising the project, not the company. So the company's details must not be part. This is where that incremental, the company detail is not incremental to the project. It's not incidental to the project. Good. Now let me slide this under the incremental. So I write something on the board, then you tell me how to be accounted for. Let's assume that sales revenue. Sales. This is how we stated the sales. The companies prepare their financial statement. And then at the same time, we are appraising a project. 2019. So 2019, everything here is for 2019. With the project. With the project. So project. The name of the project is Project A. Without the project. Without the project. So with and without the project. So sales revenue with the project, they had 390,000 Ghana. Without the project, they have 280,000. So now tell me, assuming that I am preparing the MPV, this is my MPV layout. Year 2019. Tell me the sales revenue that I have to include. So in the MPV calculation, which of the sales will I use? Will I use the 390 or I'll use the 280? Yes, 280,000. Start work. The answer is in, let me know. This is a question. There's a certain project, and now you want to appraise the project. These are the details given to you. These are the operational costs. So operational costs, here is 200. I'm wasting the case. You want to waste the case. Then here's 150. You want to waste the case. So now net cash flow. Assume that here is what 190, and here it is 130, right? I want to waste the case. Second answer received. Great, 130,000. And then we are done. That's the next. Discount factor is 10%. Calculate the MPV. The cost of capital is 10%. Now the question is, you have details of the company's performance together with the project. So this result is the company's performance plus the project. This is it. This is the company's performance without the project. If they don't consider the project, the company's performance, the sales would have been 280,000. Right? They should consider the project. Their sales is now 390,000. So which details are you going to use? Which details? So are you going to use with the project or without the project to calculate for the NPV? Great. Now, the issue is this. You have to create a column. It means that after they have added the performance of the project to the company's own result, they are getting what with the project. So what the project own? The project own is what? What should I add to 280 so that I can get 390? So the project sales revenue is 110. So I have to use 110. Obviously, this one is coming from the project. So I added the project result plus the company's own result without the project. I'll get what with the project. So obviously, this is incremental. This is not incremental. This one is not incremental. You're looking for the details solely traced to what? The project, not the together with the company. Or not the company's financial statement. If you pick this one without the project, that means you are appraising what? The company. You are not appraising the project. If you pick this one too, you are appraising both the company and the project. So what are you looking for? You're looking for just the project, then you have to what? Pick this one. So that's just for the project. So in short, you 50 or so. So this one is that's 60. And here to be 50. So here to be 50,000. You take it off, you get 60. Then you find the present value on the 60. We are done. Good. So basically, that is how we will go by. So I'm done with the relevant cash flow. So let me back with what? With illustration. I'm done with the relevant cash flow. I'll back with illustration. I'll back it with illustration. So I'll solve the first question. The first question will be a past question. So I'll solve that one, and then I'll still go through some few items. Then you are done. So I'll solve the last question in the handouts. The last question. The last question. Good. So we are solving this. You are solving this. Good. We are solving this. Okay. Now we are calculating the MPV of this project. Yes. And then in our next meeting, we will pick the adjustable. We will pick adjustable. Good. So let's see. It says that the company plans to introduce a new product line for the production of its local drink in Wale Wale. The company therefore decided to acquire either semi-automated plant or an automated plant. The relevant data for the two proposed plants are as follows. Now, we have to look out for the decision rule of Mpv. The decision rule of Mpv is that you accept what? The project with positive Mpv. Project with what? Positive Mpv. If it's a single project. Once the Mpv is positive, accept. If the Mpv is negative, reject. We are done. And then if the projects are, let's say 2 or more, that's multi, then what do you have to do? You select the project with what? Highest Mpv. The highest Mpv. Then you are done. Then left with 1. I will explain that one. Like situations where the MPV will be negative, but still you have to accept the project. Situation that one goes beyond the financial appraiser. Sometimes the MPV will be negative, but still you have to accept the project. At what instance? Let's assume that you go and promise someone that I'll bring some goods to you at 1,000 Ghana cedi to buy. You've signed agreement, contract, and you have to submit this item to the person in 6 months' time. But you need some special machine. So, in fact, you sign the contract. So even if the MPV is negative, I have no choice than to go and fulfill your parts of the contract. Or sometimes to some company do that for brand name, and then for customer loyalty, want to be loyal to his customers. So even if the MPV is negative, you will sacrifice and produce it. Good. So here you're not going to consider the financial terms. You're going to consider what? The qualitative aspect. The qualitative. So anytime the examiner asks you that, should they go ahead and accept the MPV even though the MPV is negative? On what basis or what factors can the company accept this MPV even though it's negative? Then the examiner is asking you to bring the qualitative, because the MPV look for what? The quantitative. So now bring the qualitative out. Good. So that is it. Now let's look at this question. So that's the, oh, I should change the question. This one is the one I said that you are doing it, so now I'm come to do it. Once homework, I might not do the homework. If it's homework, no. Homework are done by the people. You are done, no. Down code, no. There's a question called Abrifa Kwame, no. Ajasco, yes. Papa Ajasco. That's November 2017, question 1. Papa Ajasco. So that's page 32, question number 1. Tutorial question 1. Papa Ajasco. Good. Now look carefully how we are going to answer this question. Extremely careful. Good. Now let's see. Ajasco Limited, a software company, has developed a new game called Landu, which it plans to launch in the near future. Sales volumes and production volumes. Volume simple means quantity or units. So sales units or sales quantities, and production units and the selling prices for the Landu over its 4-year life are expected to be as follows. So the production units are there: 150,000, 70,000, 60,000, 60,000. We are done. Selling price, they are all there from 25 to 22. Financial information on the Landu for the first year of production is as follows. Direct material cost, 5 cedis, 5 cedi, 40 pesos per game. Other variable production cost, 6 Ghana cedis per game. Fixed cost, that is 4 cedi per game. So fixed cost, 4 cedi per game. we said that the only fixed cost that we have to include is what? The incremental. It must be what? Incremental. So the incremental fixed cost is what we want. It's what we are looking for. Good. Now let's see. Advertising costs to stimulate demand are expected to be 650,000 in the first year of production and 100,000 in the second year of production. No advertising costs are expected in the third and fourth years of production. Fixed costs represent incremental cash fixed production overheads. I like the term because not every fixed cost that we are going to include. The fixed costs that we have to reject are the general fixed cost. Normally, they will apportion it, reject it instantly. We don't like apportionment. Why do you share? No, you might not share it well. We want the direct allocation. We want the direct ones. Good. Here we are saying Lando will be produced on a new production machine costing 800,000. Although this production machine is expected to have a useful life up to 10 years. Useful life up to 10 years. Government legislation allows Ajasco Limited to claim the capital cost of the machine against the manufacturer of a single product. Capital allowances will therefore be claimed on straight line basis over 4 years. For that session, I will explain it first before we tackle the main question. Because so far, that's the only issue that we've not explained. Now let's go to the notes. Ajasco Limited pays tax on profits at the rate of 30% per annum. And tax liabilities are settled or paid in the year in which they arise. Ajasco Limited uses an after-tax discount rate of 10% when appraising a new capital investment. Ignore inflation for now. Good. Now let's see. So I'll explain the tax savings on capital allowance. Tax savings on capital allowance. Then we start with this. Papa Ajasco. Papa Ajasco. Papa Ajasco. So tax saved on capital allowance. Let me explain that one first. Then we need to solve this question. Tax saved on capital allowance. You saw it in the format. Tax saved on capital allowance. Now the tax authority will not accept depreciation. The tax authority will not accept what? Depreciation. But instead, they will grant what we call capital allowance. So that capital allowance will save you from paying certain taxes. So we have to include it as a plus. Because we do not include depreciation, you have to include the capital allowance in it. So all what you have to do is calculate the tax month's depreciation and multiply it by the rate. So you should know how to calculate depreciation. Here is tax month's depreciation. Tax month's depreciation. That's how I call it. So if it's a tax month depreciation, then we have to pick tax month's rule or tax rules to calculate it, not the accounting rule. So if I state how the company depreciate their assets and give you how the tax authority also depreciate assets, you have to go in for the tax authority's own and leave the company's own. How we get it? Good. So that's the tax month's depreciation. Now let's see how best we can calculate. So here, for the term is called capital allowance. That's the tax month's depreciation. So I have a nice format for you. All what you have to do is bring your year, bring your depreciation, and tell the examiner that the tax rate will be like this. So calculate your depreciation. So your depreciation year one, year two in that order. If the depreciation is 3,000 and the tax rate is 20%, it's okay. 20% times the 3,000. Then you get to what? 600. That becomes the tax saved rate. So basically that's the tax saved. Then what do? You include it in the MPV calculation where we place it. However, it must move with the pattern or the tax cash flows. If you pay tax 1 year in arrears, all the enjoyment you have to also enjoy it 1 year in arrears. This one is enjoyment. So what do? You can also claim the capital allowance 1 year in arrears. Yes. So if in that case, year one capital allowance will go to where? Year two. So timing, this one goes to year two, this one goes to year three, and then year four in that order. Great. So this is the end of the capital allowance. At this stage, I'm expecting everyone to be okay in the calculation of depreciation. Now the two method, either use the straight line method or the reducing balance to calculate the depreciation. Or they can also come out with their own rule, maybe 50% write-off in the first year, the remaining balance later, or spread on the asset life. So that is it. So I'm done with the capital allowance. So we use the one in Ajasco to do the calculation. So now let's see if we can finish Ajasco. So now let's go to the actual question. So where do we start from? We said that in MPV layout, we start from the sales revenue. Good. So now let's see. We have to start with the MPV layout. So NPV layout. Pa Ajasco. The Chinese people at work. Okay. So you start with your year. So year zero. But how many years? 4 years, right? So year one, year two. But the years, they are very tall. And they tall like that. So year zero, year one, year two, year three, and then year four. I hope tax is not paid 1 year in arrears, which we have to add 1 year to it. Good. So that is it. So start from sales. So our sales will be here. We're going to do workings and bring it in. So the sales revenue, you pick your calculator and then you perform the workings for us. So when went to the question, they are going to produce what? 150,000. The selling price is what? 25 cedis. So what will be the amount? Now the amount will be very big, not very big. Like by let's rate 3 zeros to be on safer side. So I'm going to rate 3 zeros here. So I'm working in thousands. I'm working in thousands. So the year one sales will be, so for the year one, the sales will be
3,750.
the 150 by the 25. That will give us
750.
3,750. So that is the sales revenue for the first year.
And 2 is 1,680.
So 1,680, right?
Yes, 3,380.
Same 1,380.
80
380.
year 4. 1,320.
So 1,320. We are done with the sales. Now let's go to the variable costs. Hey, trouble. It's an issue. Now let's go to the variable cost. The variable cost. What is the variable cost in this question? That one to the same show. Have to pass through the same show. So variable cost. That one, let's do some few adjustments here. They are saying that direct material cost is 5.4 per game. Other variable production cost is 6 Ghana cedis. So what will be the total variable cost per unit? That will be 11 cedis, 40 pesos. So you pick each of the units, then you multiply by what? 11 cedis, 40 pesos to get the total variable cost. So 150 by 11 cedis, 40 pesos.
1,710.
Good. So that'll be 1710. The first one will be 1710.
And the second one will be 798.
Good. So 798.
684.
Then we have 684. Good. We have 684 again. Good. So we put them in 9 brackets. You are subtracting. So that is it. Here we can just add subtract the fixed costs together so that we can get a profit straightforward.
Yes.
So let's take off the fixed cost straightforward. You can also just subtract this one from this and get the contribution first before subtracting the fixed cost from it. So we are doing it different. Now let's go and read the fixed cost. Okay. Now calculate the fixed cost for me from year 1 up to year 4. What will be the value of the fixed costs? Then we are done. Good. Good. So here, the fixed cost will be for the first year of operation. They had 4 by the 150, making 600. So the fixed cost for the first year is 600. Now, when you go to the second year, don't worry yourself, repeat it because fixed cost is what is fixed between a relevant range. If you change it, you're making it variable cost. Fixed cost does not vary. So we just get one and it might be the same for all of them. 600, 600, 600. And that was the game.
Strategy.
So basically, that is it. Good. Now you can also here when you have something like that, look for the highest unit. You look for the highest unit and value it, use it as a first cost. That's the one approach. Approach number two, use the average or the normal activity. Average units. Good. So these are the approach that you can go by. Or you can also use the first year one, the first year's operation. So if you meet question like that, where the fixed cost was per unit, fixed cost of 5 Ghana cedis per unit, fixed cost of 5 Ghana cedis per unit. These are the 3 acceptable way to value the fixed cost. How do you get it? Good. So either use the first year of operation as a basis or use the average or the normal or the highest because the fixed cost is between a relevant range. And here, thank God, the first one is the highest, so it corresponds. So if you go by this and this, because 150 happens to be the highest is the first one, but that's not always the case. And then the average, I like these two methods, highest and average. I think that would be a very good one. Highest and the average. Okay, I'm done with the first call. Let's go to profit. Everybody this question quickly. Let's go to profit. So profit for the period will be, hey, you're not done. There's another cost in it. Yes. There's another cost. Let's go and pick it up. Okay. Now the fixed costs, the section that explains the fixed cost, they are saying that the fixed cost represents incremental cash fixed production overheads. We said that not all the fixed costs that are relevant. The relevant fixed cost is what? It must be the incremental. So if I don't see incremental attached to the fixed cost, I will not add it. I'll not include it here. You have to tell me that it's incremental before I have to pick it. Or if you don't tell you, there's a statement that we would say, like fixed cost of 10 Ghana cedi will be incurred. See the word would be incurred, will be incurred in future, or would be incurred. All of them, when you see them, you have to pick. That means it's incremental fixed cost. It will be incurred in what? Future. That is it. Good. So in a question, they are just explaining that this fixed cost is what? Is incremental. That's now there was advertising costs of 650 in the first year of production, 100,000 the second year, And that's all. So 650 first year, 100,000 second year. We are done. So advertising. So 650 in the first year, 100,000, none. So let's quickly calculate the profits. So profit will be okay. Now let's see. Okay, so 790. Good.
182.
182.
96.
96. And finally,
36.
good. That is it. Now, according to the question, the company paid tax in the same year. So let's bring it. And tax is at the rate of what? 30%. Tax is at the rate of what? 30%. And here, are they paying tax in the same year or 1 year in arrears? Tax is paid in the year that arise. So settlement. That means it's in the same year. So you have to charge the tax and then include it in the same year. In fact, I've written items here plenty, so I have to shift it back small. So I can get so tax into bracket 30% dash. So let's see. So you get
237.
237 for the first year. You put in bracket
Second one 54.6.
54.6.
28.8. And 10.8.
Let me see. Good. So you get something like okay, so that's it. Good. So 28.8. Then you have
10.8.
good 0.3 by 36. So that'll be 10.8. Good. So 10.8. You put it in. So it's positive figure. We are gaining. Then the tax saved on capital allowance, tax saved right after the tax there. Now the tax saved, we said that is the taxman's depreciation times the tax rate for each of the years you are done. So let's go and see how the taxman will calculate the depreciation or the tax law.
So I think it's a positive figure.
Okay, so the tax, we have to put it all of the bracket to we are subtracting. Good, we are subtracting because the cost. So let's go and look for the tax save. So here we are saying that although this production machine is expected to have a useful life up to 10 years, government legislation allows Ajasco Limited to claim the capital cost of the machine against the manufacturing of single products. Capital allowances will therefore be claimed on straight line basis over 4 years. So you're going to use 4 years or 10 years. So here you're going to use 10 years or 4 years. What's the cost of the machine? 800,000. So you have to just calculate the tax man's depreciation. Here we have to use the tax rule, not the companies, what the companies expect from the machine. No. Good. So here we have to use the tax man. So that means depreciation will be straight line over 4 years, not 10 years. So over 4 year period. So depreciation of 800 Ghana. So the depreciation, when working somewhere, we said the tax save on capital allowance. Capital allowance is the depreciation. So therefore, the depreciation will be what? The 800 divided by 4. That will give us 200. Now, tax save will be what? So tax save will be equal to the 200 times 30%. That will give us 60. So every year they will have a gain of 60. So tax save is workings number 1. Tax save is 60. So 60, 60, 60, 60. We are done. Now let's see if there's any issue in the question. No issue. We've touched every figure. Okay, so now we are through. So therefore, what will be the net? So here there's no working capital. There's no scrap value. So go to cost of investment. Cost of investment, which is 800,000, which will be recorded here, negative. So now let's find the net. So the net cash flow will be what? So this is the net cash flow. So net cash flow here will be 800 negative. So summation of this in that order. So therefore the first year will get something like the 790 less 237 plus 60. That's 613 for the first year. 613. Second year will be 182 less 54.6 plus 60. 187.4. 187.4. So 96 minus 28.8 plus 60. 127.2. That's 85.2. Good. Now let's see. So discount factor at 10%. So 0.909, 0.826, 0.751, and then 751 and 0.683. 0.683. So 0.683. So you analyze it nicely, then we find the present value, then we are done. So let's see. So what's the present value? So PV of cash flows. PV of what? Cash flows. So PV of cash flows. So PV of cash flow will be, that will be 800 negative this times this. Good. So what do you get? So that is point 909 times 613. That's 557.22. 557.22. Then 187.4 times 0.826. That's 154.79. Good. Now let's see. Great. So the last one will be the last version 127.2 times 0.754. 95.53. So 85.2 times 0.683. $58.19. So negative, add or take the negative of, then you are done. So therefore, the answer will be minus 800 plus 55720 plus 154.79. Good. So the next one will be what's the 79? So 95.53. So plus 58.19. So the MPV is 55,228.54. So we find somewhere and then we record it. Space is not there. So let's find somewhere and record MPV. So therefore the MPV is equal to the 55,228.51. Once it's positive, they should do what? They should accept it. Good. So we are done. The MPV is positive. They should accept it. Great. They should accept the project. Now we are done. This is how far the good Lord will bring us. But if you do have any question, kindly let me know. If there's no questions, then this is how far the good Lord will bring us. Thank you. So thank you very much for watching. Kindly subscribe if you have not done that, and then tap on the notification button if you have not done that. Thank you. Bye.